If you've built a successful business in the United States and you're still paying the IRS like you're a W-2 employee, this video is going to change everything you thought you knew about building wealth. I'm not going to give you some teaser masterclass and then try to sell you a course at the end. I'm going to give you the complete playbook, the actual strategies, the real mechanics, the specific tax code sections, everything. I'm Joey, co-founder of Preserve Wealth Group, and for the last 5 years, I've worked side by side with hundreds of the top 0.1% of financial professionals in the United States. Advisors who specialize in implementing the most efficient financial strategies for 7, 8, and 9-figure business owners and wealthy families. And in that time, I have learned a thing or two about what separates the tax strategy playbook that successful business owners and high-income professionals can implement, so the same strategy the ultra-wealthy have been using for decades, from what most people are being told. The gap has never been about whether these strategies exist. They've been in the IRS tax code since the 1950s. The gap has always been about access to education. So my goal today is simple. Pull back the curtain on how the ultra wealthy actually protect and grow their money without gatekeeping and without unnecessary complexity and without the fluff. So I'm a business owner at my core. I've implemented these strategies for myself and those closest to me, and I've had the chance to be in the front row seats watching tens of thousands of business owners implement them through my network from the past several years, saving tens, if not hundreds of millions of dollars in unnecessary taxes. And today, I'm revealing what I've learned. Now, before we go any further, and you'll see this on the screen, this is educational content only. This is not personalized tax or financial advice. Every situation is unique, and you need to work with qualified licensed professionals before implementing anything I discussed today. Cool? Let's get into it. Over the next hour, I'm going to walk you through 6 different chapters, so feel free to watch one at a time and come back to it later by saving this video in your watch later playlist, or just watch it all in one sitting, whatever you wish, okay? Chapter 1, we're gonna cover why there's a gap between what your CPA knows and what you actually need, and why it's not their fault. Chapter 2, the specific tax code sections that allow business owners to create significant deductions while building tax advantage wealth. Chapter 3, the critical difference between tax deferred and tax free, and why getting this wrong could cost you hundreds of thousands over your lifetime. Chapter 4, how Fortune 500 companies have used this strategy since 1954 and how business owners can access the same playbook. Chapter 5, who these strategies are actually designed for, because they're not for everyone, and I'll be completely honest about who qualifies. And finally, Chapter 6, the implementation framework and what to do with this information. But before we dive in, let me give you the single most important insight from this entire video right now, because I want you to get value even if you never watch another minute. The reason most business owners overpay in taxes isn't because they have a bad CPA. It's because the strategies that could help them the most exist at the intersection of 2 different professional licenses. And the person with one license legally cannot do what the other person with the other license does. So your CPA is trained in tax compliance. They're experts at taking your financial situation and minimizing your taxes within the strategies they're licensed to implement. But there is an entire category of IRS-approved strategies that requires both tax expertise and insurance licensing to implement properly. And since your CPA doesn't have an insurance license, they cannot legally design or implement these strategies for you. This isn't a flaw in the system, it's just how professional licensing works. And understanding this gap is the first step to closing it. Now, let me show you exactly what I mean. So let me ask you a question that might make you uncomfortable. If there were legal strategies in the IRS tax code that could potentially reduce your tax burden significantly every year, strategies that have been available since 1954, why hasn't your CPA told you about them? So I used to wonder that myself. And I'll be honest, when I first started learning about these strategies, working with those elite financial advisors that I've been working with for over 5 years now, I thought there must be some catch. Maybe they were just too risky. Maybe they were in some gray area, and nobody wants to be in that gray area, right? Especially when it comes to taxes. So maybe they only work with mega wealthy business owners, Jeff Bezos, Warren Buffett of the world. But The more I study the tax code, the more I talk to those professionals implementing these strategies daily, the more I realize these strategies are completely legitimate. They're written right into the Internal Revenue Code. They've been used by Fortune 500 companies for decades, and they can potentially benefit business owners at many different income levels. So why the silence? Here's what I discovered. It's not a conspiracy. It's a licensing gap. Think about it this way. In the medical world, a general practitioner is excellent at diagnosing common problems, prescribing medication, and keeping you healthy day to day. But if you need heart surgery, they're not going to do it themselves, not because they're a bad doctor, but because heart surgery requires different training, different tools, and a different license. The same structural gap exists in financial services. Your CPA is trained in tax compliance. Their expertise is in taking your financial information, maximizing deductions within the strategies that they know, and filing your returns accurately, keeping you legal with the IRS, and they're typically very good at that. Some of the most powerful wealth building strategies in the tax code, strategies that can potentially create significant deductions while building tax advantage assets, sit at the intersection of tax law and life insurance design. So what happens? Business owners end up in this no man's land. Your CPA knows taxes, but can't implement insurance-based strategies, and your insurance agent knows insurance, but may not understand advanced tax planning, so how to use insurance as a tax advantage benefit. And the strategies that could help the most remain invisible for you. Now, I'm not making this up. These strategies are written directly into the Internal Revenue Code. Let me give you the actual citations right now, which you can cross-check in the description of this video. IRC Section 61 defines gross income. IRC Section 162A1, ordinary and necessary business expense deduction in the code since 1954. IRC Section 79, group term life insurance taxation. IRC Section 101A, life insurance death benefit exclusion. So IRC Section 401A, qualified pension plan requirements. IRC Section 404, deduction limits for employer contributions to qualified plans. IRC Section 412, this is the minimum funding standards for pension plans in the code since 1974. IRC Section 412E3, these are fully insured defined benefit plans. And there's IRC Section 415, which is limitations on benefits and contributions. IRC Section 7702, these are life insurance contract definition and taxation. So again, these aren't loopholes. They're not aggressive tax shelters either. They're fundamental parts of the tax code that have been there for 50 to 70 years. The question isn't whether these strategies are legitimate. The question is why most business owners don't know about them. And now you understand the answer. It's not that your CPA is keeping secrets from you. It's that the strategies require a combination of expertise that most single professionals don't have. The next chapter, I'm going to break down exactly how these tax code sections work in plain English with real examples so you can understand the mechanics yourself. Now that you understand why there's a gap, let's talk about what sits inside that gap. I'm going to break down the specific tax code sections that make these strategies possible. And I promise to make this as simple as I possibly can because tax code isn't exactly light reading. And I was the first one to be extremely confused when I first started in business. So here's how I want you to think about this chapter. I'm going to show you the building blocks. These are the tools in the toolbox. In later chapters, we'll talk about how they get assembled together into actual tax saving strategies. So let's start with IRC Section 162. Section 162 is the part of the tax code that allows businesses to deduct ordinary and necessary business expenses, including reasonable compensation paid to employees and executives. Now, here's where it gets interesting for business owners. If you own an S Corp, a C Corp, or certain LLCs, you are technically an employee of your own company. So you might also be an executive or an officer. And that means that your business can pay you additional compensation beyond your regular salary. And under Section 162, businesses have been able to structure what's called an executive bonus plan. So since 1954, it's been in the tax code. And here's the basic concept. 1, your business agrees to pay you, the owner, the executive, a bonus. 2, instead of receiving that bonus as cash that gets added to your W-2, right, to your salary, the bonus is used to pay the premiums on a permanent life insurance policy that you personally own. 3, your business then deducts those premium payments as executive compensation under Section 162. 4, the life insurance policy you now own accumulates cash value that, when properly structured, can grow in a tax-advantaged way. There's also revenue ruling, so 64 and 328, that specifically addresses executive bonus arrangements, providing guidance on how these should be structured. Now, let me be clear about something, right? Simply buying any life insurance policy doesn't automatically give you these benefits, which is why, to be honest, life insurance does have a negative connotation for a lot of business owners, but that's because it was never structured properly by a real professional that actually understands tax-saving vehicles that the wealthy use that are available to qualified business owners. The policy needs to be properly designed and structured. The compensation arrangement needs to be properly documented. So there are specific requirements that needs to be met. This is educational advice, obviously, not implementation advice. Actual implementation requires working with qualified professionals who understand both the tax side and the insurance side. So make sure that your team actually understands that. Now, let's talk about Section 412. And this is where things get really interesting for business owners who are over 50 years old with stable, significant income. So I will assume that you're familiar with the 401k plans. In 2024, the maximum employee contribution to a 401k was around $23,000 or about $30,500 if you're over 50, with catch-up contributions. So even with employer matching and profit sharing, you might get to around $66,000 to $69,000 in total annual contributions under Section 415 limits. For a business owner paying substantial taxes, these contribution limits can feel frustratingly small. So enter Section 412, which are minimum funding standards for defined benefit pension plans. So unlike a 401k, which limits how much you can put in, a defined benefit plan is based on what you want to get out in retirement. The contribution limits are based on actuarial calculations on how much needs to be contributed today to fund a specific future benefit. So for older business owners with stable, high income, this structure can potentially allow annual contributions that are significantly higher than 401k limits, in some cases, several times higher. There's also Section 412E3, formerly known as 412I plans, which allows for fully insured defined benefit plans. These are particularly interesting because they use insurance products as the funding mechanism. Now, here's where both sections can potentially work together. With proper structuring, some defined benefit plans can use specifically designed life insurance as part of the funding mechanism. So when this is done correctly, 1, the business contributes to the defined benefit plans, and those contributions are deductible under Section 404. 2, the plan purchases life insurance as part of its investment strategy. 3, the insurance policy grows within the tax advantage plan structure. And 4, in retirement, benefits can potentially be accessed in tax efficient ways. So let me also mention a few other relevant sections from the tax code as a little bonus to this chapter. The IRC Section 264 governs certain amounts in connection with insurance contracts. There's the IRC Section 409A that covers non-qualified deferred compensation rules. There's the IRC Section 419 and 419A that address the treatment of funded welfare benefit plans. And these all work together as part of the broader framework that makes advanced planning possible. Now, I want to be completely honest with you. This is complex, and I've just given you a 30,000-foot overview of strategies that have entire textbooks written about them. The actual implementation involves actuarial calculations and enrolled actuary involvement, IRS compliance requirements, ERISA considerations, and Department of Labor rules plan, document drafting, annual filings like Form 5500, insurance policy design optimization, exit strategies and distribution planning. This is not a do-it-yourself project. This is not something you implement. after watching a YouTube video. This requires working with qualified professionals, ideally professionals who have both expertise, so the tax side and the insurance side. But the goal of this video is simply to make you understand why these strategies exist, where they come from in the tax code, and why your CPA likely hasn't mentioned them to you. And I think it's very important because there's nowhere else that I had to learn it through the 5 years of connecting with the network that I had. And there's no information online or other videos or books even that are sharing this information. And this is what I'm trying to do with you today. In the next chapter, I'm going to explain something that I think is even more important than understanding these specific strategies, and that's understanding the difference between tax deferred and tax free. Because getting this concept wrong could be one of the most expensive mistakes a business owner can make in their whole career. So let me show you what I mean. When you contribute to a traditional 401k or traditional IRA under Section 401A or Section 408, you get a tax deduction today. That feels good. You see a smaller number on your tax return and you think, I'm saving money on taxes. But here's what's actually happening. You're not eliminating taxes, you're postponing them. The money you contributed, it's going to grow over 20, 30, maybe 40 years. And every single dollar, including all the growth, ordinary income when you withdraw it in retirement. Now, let me illustrate with an hypothetical example. And I want to be clear, these are illustrative numbers to explain the concept, not projection of what anyone will actually experience. So imagine a business owner who contributes to tax deferred accounts over their career. Let's say their accounts grow to $2 million by retirement. Now they start withdrawing in retirement. And if they're in a 30% combined tax bracket, they could owe $600,000 in taxes on those withdrawals. So did they save money on taxes, or did they just delay paying taxes and end up paying taxes on a much larger sum because the account grew, right? Now, consider the alternative, vehicles that provide actual tax-free growth and access. So these are like properly structured life insurance, for example, is one of the few vehicles in the tax code that offers this combination under Section 7702 and Section 101. So step one is the cash value can grow without being taxed each year. So the tax-free growth under the IRC 7702. Two, you can actually access the cash value through policy loans, and this is generally not a taxable event. 3, you get death benefits that pass to beneficiaries income tax-free under IRC 101A. So when structured correctly, this creates a scenario where your money goes in on an after-tax basis, or through properly structured business deductions, your money grows without annual taxation, and your money comes out without triggering income tax through loans, for example. So the money passes to heirs without income tax. So here's the key insight that most people miss. With tax-deferred vehicles, you're essentially forming a partnership with the IRS. You're going into business with the IRS. So they're your silent partner in your retirement account. You cannot see them, but they definitely own a percentage of everything you've accumulated, and they're going to collect when you start withdrawing. With properly structured tax-free vehicles, you're paying your taxes up front, or creating deduction through business structures, and then you get to keep the growth. Now, I want to be balanced here, right? Tax-deferred vehicles aren't bad. For many people, they make sense. And if you expect to be in a significantly lower tax bracket in retirement, well, deferring taxes could actually work in your favor. But here's what I've personally observed working alongside top advisors who actually work with very, very successful business owners. Many of them don't end up in lower tax bracket in retirement, so you shouldn't take the advice of someone that will end up in the lower tax bracket, right? Makes sense. They've built successful businesses, they have investment income, they have rental properties, they're not living on Social Security alone. So for these business owners, deferring taxes might mean deferring into the same or even higher tax brackets, while also giving the IRS a larger pie to tax because of all that growth, which is why the IRS isn't advertising those strategies to everybody, because they're winning out of it, right? So here's the framework I want you to take away. Ask yourself, do I expect to be in a lower tax bracket in retirement than I am today? If the honest answer is probably not, then you need to seriously evaluate how much of your wealth building is happening in a tax-deferred vehicles versus tax-free vehicles. This isn't financial advice, it's a framework for thinking about your problem. And it's the same framework that I've used personally myself. So your specific situation requires specific analysis with qualified professionals. Now that you understand this fundamental distinction, let me show you who's already been using these strategies successfully, and it might surprise you how long these approaches have been in play. Have you ever wondered how Fortune 500 executives seem to accumulate so much wealth and pay proportionally less in taxes on it? Well, it's not magic, it's definitely not illegal. It's executive compensation strategies that have been standard practice in corporate America since the 1950s. And here's what's interesting. As a business owner, you have access to many of the same tools. So when large corporations want to attract and retain top executives, salary alone isn't enough. High earners quickly hit the point where another dollar of salary means giving 40, 50, or even 60 cents of that to taxes when you combine federal, state, and payroll taxes. So corporations develop sophisticated compensation packages that include things like executive bonus plans, deferred compensation arrangements under Section 409A, supplemental executive retirement plans, split dollar life insurance arrangements, key person insurance strategies. So these aren't fringe benefits or loopholes. They are fundamental tools of executive compensation that every major corporation in America uses. There's even guidance from Revenue Ruling 66-110 on employer-owned life insurance. And here's the insight I want you to have. So if you own an S Corp, C Corp, or certain LLCs, you are an executive of your company. You're not just the owner, you're not an employee, you're likely an officer. You're the CEO, the president, or whatever title you've given yourself. And that means that the same categories of strategies that Fortune 500 companies use for their executive can potentially be structured for you. So the scale might be different. A Fortune 500 executive might have millions of dollars flowing through these structures. You might have tens or hundreds of thousands, but the fundamental mechanics are similar. So why do so few business owners know about this? Well, think about how most business owners interact with their advisors. They meet with their CPA for tax prep. The CPA focuses on compliance and the strategies within their expertise. They might meet with a financial advisor who recommends 401ks and IRAs because those are the tools they're licensed to offer. They might have some life insurance from an agent who just sold them a term policy years ago. But none of these professionals is giving them the full picture. Not because they're bad at their jobs, but because the full picture requires expertise that crosses professional boundaries. Fortune 500 executives benefit from entire teams of advisors whose job is to optimize their compensation. So business owners typically have to find this expertise themselves, if they even know it exists. So the good news is that now you know it exists. You don't have to be a Fortune 500 executive to implement executive level strategies. You just need to find the professionals who understand how to apply these strategies at the scale that's appropriate for your business. But here's the thing, these strategies aren't for everyone. In the next chapter, I'm going to be completely honest with you about who qualifies for these approaches and who doesn't. Because implementing the wrong strategy or implementing the right strategy in the wrong situation can actually make things worse. So let me be completely honest with you about who these strategies are for and who they are not for. I've seen too many people implement strategies that weren't right for their situation, and I'd rather you watch this chapter, realize these strategies aren't for you right now, and move on to focus on where you need to focus instead, than have you pursue something that doesn't make sense for your circumstances. So let me start with who should probably look elsewhere. So first of all, W-2 employees without business ownership, these strategies require business entities in the most cases to create the deductions and structure the compensation arrangements. So if you don't own a business, the mechanics I've described just doesn't apply to you. Business owners in the early startup phase. So if your business isn't yet generating consistent, significant income, if you're still reinvesting everything back into growth, the capital commitment these strategies require probably doesn't make sense yet. So focus on building your business first. People who need maximum liquidity. So these strategies typically involve committing capital over extended periods. So if you might need access to every single dollar in the next few years, locking money into long-term structures most likely isn't appropriate. Business owners with inconsistent income. Many of these strategies require consistent funding over multiple years. So if your business income swings dramatically from year to year, the commitment structure might not work for your cash flow. Now, who might benefit from exploring these strategies further? So these are established business owners with consistent profitability. So if your business has been generating stable, significant income for multiple years, you have the foundation for these strategies. Business owners that are currently paying substantial taxes. So if you're writing meaningful checks to the IRS and looking for legitimate ways to create deductions while building wealth, these tools deserve exploration. Business owners over the age of 50 who want to accelerate retirement preparation. So Section 412 defined benefit plans in particular can offer significantly higher contribution limits for older business owners, but they require stable income and commitment. Then we got business owners who value tax-free income in retirement. So if you expect to remain in high income brackets in retirement and want to create tax-free income streams, these structures deserve consideration. They've got business owners who want to create legacy wealth. So if passing wealth to the next generation in a tax-efficient way matters to you, the death benefit components of these strategies become very relevant. So here's the honest truth. These strategies involve complexity and commitment. They're not a set it and forget it solutions. They require ongoing premium or contribution commitments, working with qualified professionals, understanding the rules, and staying compliant. Patience, these are long-term strategies. So if you're looking for a quick fix or magic bullet, this isn't it. But if you're willing to make a long-term commitment to building wealth efficiently and you meet the criteria I just described, well, these strategies could be worth exploring with qualified professionals. So in the final chapter, I'm going to talk about what to actually do with this information, how to evaluate whether these strategies make sense for you, and how to find professionals who can help you implement them properly. So now you understand the landscape, you understand why your CPA hasn't mentioned these strategies, you're understanding the basic mechanics, right? You understand who qualifies and who doesn't. The question is what do you actually do with this information? So first, definitely don't fire your CPA, please. Your CPA is still definitely essential for tax compliance, filing your returns, and day-to-day tax advice. The strategies I've described don't replace what your CPA does. They supplement it. Think of it as healthcare. You still need your general practitioner, even if you're also seeing a specialist. So they just serve different functions. Second, internalize what I've shared about the cap. So there's a category of strategies that exist outside of what most CPAs can implement, not because they're bad at their jobs, but because those strategies require different licensing, different expertise. So knowing this gap exists is the first step into closing it. Third, honestly take the time to evaluate your situations against the criteria I shared. So are you an established business owner with consistent, significant income? Are you paying substantial taxes that you'd like to reduce? Do you have the ability to commit capital over multiple years? Are you willing to work with specialized professionals to implement properly? If the answer to most of these is yes, well, it's definitely worth exploring further. If not, maybe revisit this in a few years when your situation has evolved. Fourth, if you decide to move forward, find professionals who operate in this gap. Look for advisors who have understanding of business tax strategy, insurance licensing and expertise, experience implementing these strategies, the ability to coordinate with your existing CPA and other advisors. This is very important because the best implementations happen when everyone works together. Your tax strategist, your CPA, your insurance professional, they should all be communicating and coordinating. Fifth, before committing to anything, run your numbers. What would specific contribution levels mean for your tax situation this year, over the next decade? What are the costs involved? What are the realistic projections? Anyone recommending these strategies should be able to show you detailed, customized projections for your specific situation, not just generic example. So I want you to use this video, and there's gonna be a workbook right below that you can download free of cost. You can have a little cheat sheet of everything that I've talked about today so you can be educated when it's the time to talk to professionals to actually see who's best fitted to implement those strategies for you. So here's the bottom line. You've just learned more about tax advantage wealth strategies in the last hour than most business owners learn in their entire careers. And frankly, most financial professionals learn in their entire careers. So you now understand what Fortune 500 executives understand. You understand why your CPA hasn't mentioned these strategies. You understand the actual mechanics of how this works. What you do with this knowledge is up to you. You can file it away and keep doing what you've been doing, or you can explore whether these strategies might help you build wealth more efficiently. Either way, you're now making an informed decision instead of operating in the dark. So if you made it this far, I just want to thank you. I know I just threw a lot of information at you. Tax code section, strategy, mechanics, qualification criteria. It's a lot to absorb, and I get that. That's why I've put together a companion resource that summarizes everything I've shared in this video with additional details and self-assessment checklists to help you evaluate your situation. So the link is in the description below. It's completely free, no credit card, no sales, no pitch, nothing, just the resource. I want to give as much value as possible so that you can hopefully share this video, share this workbook to other business owners. Our goal is to grow this channel, to be able to invest more into this channel, bring more qualified guests, and provide more education and the knowledge that I believe the community of US business owner needs in order to make educated decision about tax saving strategy. So if you found value in this video, downloading that resource is the best way to make sure you can actually use what you've learned. I'd also appreciate if you'd hit the like button and subscribe to the channel if you're not already yet. I'm going to be creating more content like this, going deep on strategies that business owners need to understand, but rarely get explained properly. And in the comments, I'd love to know, what was your biggest takeaway from this video? Was there something that surprised you, something you want me to go into deeper on a future video, special guests you would like me to invite from my network that I have? So I read every comment and it helps me understand what would be most valuable for you. So here's my final thoughts. Most business owners spend their entire career building wealth and then hand a significant portion of it to the IRS because they didn't know there were alternatives. So at least now you know that there are alternatives. What you do with that knowledge is up to you. Thanks for watching, and I'll see you guys in the next one.